An invisible fracture appeared in the silver markets this week, yet the world remained largely oblivious. While the public was preoccupied with portfolio balances and vacation itineraries, a foundational pillar of global finance quietly buckled. The repercussions of this shift could permanently alter the way we value precious metals. Imagine you are a jewelry designer in London. For decades you've used silver futures as a shield against price swings you secure a contract for. March delivery confident that you can either take the metal or simply push the agreement further out, as traders have done since the 19th century. Historically, these markets were safety nets, not delivery trucks, but this February the script flipped. Participants stopped rolling their contracts and started demanding the physical bars. Every last ounce of them. At the secret history of currencies, we track these tectonic shifts before they reach the surface. To grasp the magnitude of this, look at the recent data in January 2026. The silver exchange moved 49 million ounces of physical metal into the hands of buyers. For context, a typical month sees roughly 7 million. We aren't just seeing a slight uptick, we are witnessing 7 times the standard volume. By February, the delivery rate surged to 98%. Stop and consider that figure: 98 out of every 100 contract holders refused cash or extensions, insisting instead on the physical asset. When a futures market ceases to be a playground for speculators and becomes an emergency allocation system for a disappearing resource, you are watching the death of traditional price discovery. This is happening to a metal essential for everything from the chips in your phone to the solar panels on your roof. The price action during the scramble has been nothing short of chaotic. Silver rocketed to $120 an ounce just days ago, only to undergo a brutal $45 freefall, landing at $75 within a week. While some might assume the bubble has burst, the physical reality tells a far grimmer story. This is the thinnest reserve we've seen since the global panic of 2020, and it's occurring right as we enter the most demanding delivery month in modern history. The math is staggering. March open interest represents 429 million ounces of potential demand, even if most traders back away. The ratio of paper claims to physical metal is 4-to-1. It's a game of musical chairs where 80% of the participants are destined to hit the floor. This is why the secret history of currencies monitors these inventory drains so closely. We are approaching a moment where the exchange might simply run out of the commodity it's supposed to trade over. The last month, warehouses have been losing nearly 800,000 ounces every single day. At this pace, by the time we reach the critical first notice day this coming Thursday, the demand will be mathematically impossible to satisfy. Consider a solar manufacturer who locked in prices at $80 back in December. Their entire business model relies on receiving that metal to fulfill their own production promises. If the exchange fails to deliver and forces a cash settlement, that manufacturer must scramble into a retail market where premiums are 15% higher and wait lists stretch for 6 weeks. This isn't just a headache for hedge funds, it's a virus that spreads through every supply chain, eventually raising the cost of every electronic device you buy. The scarcity isn't a fluke, it's a structural trap. About 75% of the world's silver is actually a byproduct of mining for other metals like copper or zinc. You cannot simply flip a switch to produce more silver just because the price doubles. Those mines are governed by the demand for industrial base metals. Meanwhile, the buffer between global supply and demand has shrunk by nearly 40% in just 4 months. This is largely driven by a regulatory earthquake known as Basel III. Under these new international banking rules, holding unallocated or paper silver has become prohibitively expensive for banks, requiring them to set aside massive amounts of capital. However, if they hold allocated physical bars, that capital requirement vanishes. This has triggered a massive migration of wealth from paper promises to physical vaults, causing silver lease rates to explode to a staggering 34% as banks fight over a limited supply. This regulatory squeeze is being compounded by geopolitical maneuvers. In mid-2025, China reclassified silver as a strategic material and tightened its export doors. As one of the world's primary refining hubs, China's decision to hoard its supply has left Western banks in a desperate bidding war. We saw 18 million ounces flee the New York warehouses in a single weekend. January, most of it rushing toward London to satisfy these new banking requirements. As we look toward the end of February, the question isn't whether silver is overpriced at $75. The real question is, what is the value of an essential metal when the system used to trade it no longer functions? The secret history of currencies is dedicated to uncovering these hidden dynamics that define our financial future. If the exchange is forced to declare a force majeure or mandate cash settlements this Thursday, the credibility of the paper market will be incinerated. We are already seeing a two-tier market emerge, where the price you see on a screen has no relation to what you pay at a coin shop. While the screen says $75, the shop says $90 if they even have stock. This decoupling is the hallmark of a system in collapse. Whether we see a vertical price spike to $150 or a permanent shift toward alternative exchanges in the East, the lesson remains the same in a world of digital illusions. Physical certainty is the only true currency. The era where paper and metal were interchangeable is ending, and the premium for holding the real thing is only going up.